Welcome back to our deep dive into the source material. Today, we're doing something a little dangerous.
Yeah.
We are going to take a topic that is notorious for being incredibly dry,
Very dry.
right? Accounting standards. And we are going to try to prove to you that it's actually a story about secrets, hidden debts, and the fundamental way businesses define ownership.
It sounds incredibly dramatic when you put it that way, but honestly, it is dramatic. We are talking about Ind AS 116 today.
Leases.
Leases. But, not just signing a piece of paper to rent an apartment for a year. We are talking about a major rule change that essentially forced companies to put trillions of dollars of debt onto their balance sheets overnight.
Wait, trillions with a T.
Globally. Absolutely. I mean, think about it. Before this standard came into play, if you were a major airline, you could operate 500 planes, fly to every continent, generate billions in revenue, and if you looked at your balance sheet...
You owned 0 planes.
You owned 0 planes. You had 0 debt related to those planes. It was all invisible.
That just feels like a magic trick. How does a massive obligation like paying for a fleet of 500 airplanes just disappear from the books?
It was a very popular magic trick called off-balance sheet financing. The old rules basically allowed you to treat a lease as just a simple rental expense. You paid the monthly bill, it hit your profit and loss statement, and that was it.
So the obligation, the fact that you signed a binding contract promising to pay millions over the next 10 years, that was nowhere to be found on the balance sheet.
Exactly. So to an investor looking at the numbers, the company looked leaner, healthier, and way less indebted than it actually was. And Ind AS 116 was the regulator's way of saying, the party's over. They flipped the script.
So what's the new philosophy then?
They said, if you have a contract that gives you the right to control an asset, you effectively own a right. And if you own a right, you have an asset. And if you have an asset, well, you have a debt to pay for it.
From renting to rights, that's the huge shift.
That is the core philosophy. But as with anything in accounting, the philosophy is the easy part, the math. The math is where people get totally lost.
And that is our mission today. We aren't just going to skim the surface or talk about the philosophy. We are going to really break down the mechanics for you. We're going to look at how you actually dissect a contract, how you split the bill between the actual asset and the services attached to it, and then we are going to tackle the big formula.
Right, the right of use asset calculation, the ROU asset.
Yes. We have a specific case study to get through later. We're going to be looking heavily at illustration 28 from the source material, which involves some really heavy discounting math. We're going to dismantle that final number, the $7,035,900, piece by piece.
It's a classic example. Honestly, if you can understand how we arrive at that specific number, you understand lease accounting.
But before we get to the spreadsheets and the discounting, we have to start at the very beginning, the contract itself. Because let's be honest, contracts are super messy. You rarely just lease a truck.
Right. You lease a truck, but the contract also says the lessor is going to provide a driver, and they provide insurance. And they promise to change the oil every 5,000 miles. It's a bundle.
I always use the combo meal analogy for this. Think about it. You go to a fast food place, you want the burger. Right, that's the asset. That's the thing you want to quote-unquote own for the next 20 minutes. But it comes with fries and a drink. Those are the services. The problem is the menu just gives you one price for the whole combo, $10.
That is actually a surprisingly accurate analogy for Ind AS 116. Because the standard strictly says you cannot capitalize the fries, you can only capitalize the burger.
Because the burger is the asset. The fries are, what are the fries?
In accounting terms, the fries are a non-lease component, usually a service. You consume it as it happens. You don't own a driver. You don't own a maintenance schedule. You just pay for the service.
So step one of this entire accounting process is separation. We have to take this bundled combo meal contract and rip it apart.
Correct. We need to identify, first, is there a lease component inside this contract? And if so, is it separate from the other stuff?
Is there a specific test for this? Because just saying it feels like a separate thing probably doesn't hold up with the auditors.
There is a very specific test. It's laid out perfectly in the source material. For a right to use an asset to be considered a separate lease component, it has to meet 2 criteria, and it has to meet both of them.
Okay, lay them on me. What is criterion number 1?
It's the benefit test. The standard basically asks, Can the lessee benefit from the use of the asset either on its own or together with other resources that are readily available to them?
Readily available. That seems to be the operative phrase there. Let's look at illustration 12 from our sources to make this concrete. This is the classic equipment and operator scenario, right?
Yes, illustration 12 is perfect for this. Imagine you lease an excavator for a construction site, and the contract says the leasing company will also provide the operator.
Okay, so I have the machine, which is the asset, and the operator, which is the service. Can I benefit from the excavator on its own?
Well, ask yourself, could you hire a different operator from the local job market? Or could one of your own employees drive it?
Sure. Heavy machinery operators are everywhere. It's a standard skill.
Then the alternative resources are readily available. The excavator is functional without that specific lessor holding your hand. So it passes the benefit test. The asset can stand on its own.
Okay. Now, what if I lease a highly specialized prototype machine, like a machine that creates microchips, and it's encrypted so that it only works if the lessor's specific engineers operate it using their proprietary software?
In that case, can you benefit from the machine on its own? No. Can you go out and hire a readily available engineer to run it?
No, because it requires their proprietary people.
Exactly, so it fails the benefit test. In that scenario, the machine and the service are inextricably linked. You wouldn't separate them, you'd just treat the whole thing as one big blob of value.
Okay, that makes total sense. So first, the asset has to be independently usable. What is criterion number 2?
The independence test. The rule is that the underlying asset is not highly dependent on or highly interrelated with other assets in the contract.
This sounds like the package deal clause.
It is. Let's pull in illustration 13 here, which deals with leasing multiple assets that work together. Think about a solar power plant. A company might lease you the solar panels, the inverters, and the entire wiring system in one contract.
Right.
Technically, you could point to an inverter and say, that's a distinct box, but does the inverter have any value to you without the panels? Do the panels do anything without the wiring?
No, they're a closed system.
Exactly. If the lessee effectively integrates these underlying assets to produce a combined output, like electricity, then they are highly interrelated. You wouldn't look at the auditor and say, I have 3 separate leases here, one for panels, one for wires, one for inverters. You would say, I have one single lease for a solar plant.
So if it fails the independence test, you bundle them. If it passes, meaning the assets aren't highly interrelated, you separate them.
Precisely. You have to pass both the benefit test and the independence test to separate the components.
Okay, so let's assume we have a contract that has distinct parts. It passed both tests. We have a truck, which is our lease component, and we have maintenance services, our non-lease component. The rule says we separate them. The truck goes on the balance sheet as an asset and a liability. The maintenance stays off the balance sheet as a simple expense.
Correct. That is the fundamental mechanism.
But, and there's literally always, but in accounting, that sounds like an unbelievable amount of work.
Oh, it is a huge amount of work.
I mean, imagine I'm a global corporation. I don't just lease one truck. I lease 5,000 laptops for my employees. I lease 200 photocopiers. I lease a fleet of 1,000 delivery cars. Do I seriously have to sit down with a calculator and split the maintenance fee from the asset fee for 6,000 different contracts?
If you did, your entire accounting department would probably quit en masse. That is exactly why the standard setters introduced the practical expedient.
The glorious shortcut. How does it work?
The rule allows a lessee to choose not to separate lease and non-lease components. Instead, you can elect to treat the entire contract, the lease plus the maintenance plus the driver, as a single lease component.
Wait, pause there. If I do that, I am effectively capitalizing the driver.
You are. You are taking the cost of the driver, which really should be an operating expense, and you are shoving it into your lease liability and your right-of-use asset.
But that makes my debt look bigger.
It does. It inflates your balance sheet.
Why would any CFO voluntarily make their debt look bigger? Usually, they are spending millions on consultants trying to hide debt, not inflate it.
It's a trade-off between accuracy and sanity. Think about materiality. If you lease 5,000 laptops, the total liability is, relatively speaking, small change for a massive global company. Adding a $5 monthly maintenance fee to that liability inflates the debt by a tiny, tiny fraction. It doesn't really hurt your financial ratios in a meaningful way.
But the cost of not using the shortcut, the sheer administrative cost of paying accountants to split 5,000 invoices every month, is huge.
Exactly. So for high-volume, low-value assets, companies almost always use the shortcut. They say, fine, bloat the balance sheet a little bit. It's way cheaper than doing the math.
But I assume there's a limit to this generosity. You wouldn't do this for a massive factory lease, right?
Yeah, absolutely not. If you are leasing a corporate headquarters or a massive cargo ship, the service component might be millions of dollars a year. You do not want millions of dollars of service costs sitting on your balance sheet as debt. It would completely destroy your return on assets ratio. It might even trigger a default on your bank covenants.
Wow, okay. So the strategy is clear. Use the shortcut for the small stuff.
Right.
Do the hard math for the big stuff.
Precisely. And there is one crucial nuance here you have to remember. You have to apply this choice by class of underlying asset.
Meaning I can't cherry pick.
Right. You can't say, I'll use the shortcut for the specific car because I'm feeling lazy today, but I'll do the math for that identical car over there. You have to say, for our entire class of motor vehicles, we elect to use the practical expedient. Or, for our entire class of real estate, we elect not to use it.
Consistency is king.
Always.
Okay, so let's say we are in the big stuff category. We've decided not to use the shortcut because the asset is too valuable. We need to split the bill. This brings us to part 2, the allocation of consideration.
This is where the math starts to get really interesting. We need to look at illustration 15 from our source stack. This is the absolute textbook example of how to handle the combo meal pricing problem.
Let's set the scene for you. We have a company, let's call them Heavy Lift Inc. They are leasing a crane, and the contract includes a maintenance service plan.
So 2 distinct components. The lease, which is the crane, and the non-lease, which is the maintenance.
Now, the contract has to state a price. Let's say the contract explicitly says the lease rent is $80,000 and the maintenance fee is $10,000. Total check written every year is $90,000.
Now, a naive accountant would just look at the contract, see those numbers, and say, okay, debit lease asset 80, debit maintenance expense 10, done, let's go to lunch.
Why is that wrong? The contract literally says it.
Because contracts are negotiated documents, and frankly, sometimes they are manipulated. Imagine the landlord and the tenant are buddies. The tenant says, hey, I don't want too much debt on my balance sheet. Can we artificially lower the lease price in the contract to $50,000 and raise the maintenance price to $40,000? I still pay you $90 total, so you don't care.
Ah, I see. They are rigging the buckets to manipulate the financial statements because only the lease bucket goes on the balance sheet.
Exactly. To prevent this kind of manipulation, Ind AS 116 says, we don't care what the contract says the price breakdown is. We care about the standalone price.
We need to find the market truth.
Right. So in illustration 15, Heavy Lift Inc. has to go out to the market. They ask, how much would it cost to lease this exact crane if I didn't get the maintenance package?
And the market says observable standalone price is $85,000.
Okay. And then they ask the market, how much is this exact maintenance plan if I bought it separately from a third party?
The market says standalone price is $15,000.
So if you bought these two things completely separately, the total real-world value is $85,000 plus $15,000. That equals $100,000.
But our contract gives us a bundled price of $90,000.
So there's a built-in discount of $10,000. The bundle is cheaper than the sum of the parts. The accounting question is, who gets the benefit of that discount? Does it all go to the lease? Does it all go to the maintenance?
I'm guessing the answer is share and share alike.
Pro rata allocation. We have to split the discount based on the relative weight of the standalone prices. Think of a pie chart representing that $100,000 total standalone value.
Okay, I'm visualizing the pie.
The lease is $85,000. That is 85% of the pie. The maintenance is $15,000. That is 15% of the pie.
So we take those exact percentages, 85 and 15, and we apply them to the actual bill we have to pay, which is the $90,000 contract consideration.
Exactly. So let's run the numbers. For the lease component, it gets 85% of $90,000.
Calculator time. Let's see. 85% of $90,000 is $76,500.
And for the maintenance component, it gets 15% of $90,000.
That is $13,500.
And just to check our math, $76,500 plus $13,500 equals $90,000. It balances perfectly.
So wait, let's underline this. The legal contract said the lease was $80,000, but we are recording the lease liability based on $76,500.
Correct. We have effectively ignored the stated contract price in favor of the economic reality. We allocated the discount proportionately.
That is such a crucial distinction. If you just booked the $80K because it was written on a piece of paper, your liability would be artificially high. You'd be violating the standard.
And in the world of accounting, being wrong by a few $1,000s on a single contract isn't the end of the world. But being wrong systematically across 1,000 contracts, that is a material misstatement. That gets you in trouble with auditors.
Okay, so We have successfully sliced the combo meal. We know the actual capitalizable price of the burger is $76,500. Now we move to the next phase. We have to put this burger onto the balance sheet. We need to calculate the right-of-use asset.
The ROU asset. This right here is the absolute heart of Ind AS 116.
Now, I think a lot of people just intuitively assume that the asset value is just the exact same number as the liability value. Like, you owe $1 million, so you have an asset of $1 million.
Ideally, yes. But in the real world, almost never. The liability is a measure of debt. It's about future cash flows you are obligated to make. The asset is a measure of cost. It's about what you sacrifice to get the asset ready for use. And those two things are rarely identical on day one.
Because there are other costs involved.
Exactly. So let's look at the full formula for the initial ROU asset. This is covered in paragraphs 6.390 and 6.415. There are 5 moving parts you need to memorize if you want to master this.
Let's build it layer by layer for you. Layer 1 is the lease liability.
This is the foundation. This is the present value of all those future rent checks you are going to write. We'll get to the discounting math in a minute, but this is the big number.
Layer 2. Lease payments made at or before the commencement date.
Basically, the down payment,
Yeah.
or the first month's rent paid in advance.
Why isn't this just in the liability?
Because you've already paid it. It's not a future obligation, it's cash out the door. But it is part of the cost of the asset.
Yep.
You paid that money to get the right to use the space, so you must add it to the asset value.
Got it. So we are at liability plus down payment. Layer 3 is initial direct costs.
These are the incremental costs of obtaining the lease. Think brokerage commissions, legal fees incurred specifically for drafting this exact contract, stamp duty.
So if I pay a real estate broker $5,000 to find me the office space, that $5,000 isn't an expense on my P&L. It's an asset.
Correct. You capitalize it. You add it to the ROU asset. It's part of the purchase price, essentially.
Okay. Liability plus down payment plus direct costs. Layer 4. And this is one that always blows people's minds. Dismantling and restoration costs.
Ah, yes. The beautiful intersection of Ind AS 116 and Ind AS 37.
Let's explain this with a story because it's wild.
Imagine you lease a pristine piece of land to build a nuclear power plant. The lease is for 50 years. The contract says at the end of year 50, you must tear down the plant, remove all the radioactive waste, and return the land to a green field.
That sounds like a massive problem for future me in 50 years.
That is exactly how we used to think under the old standards. But modern accounting logic says, wait, when did the obligation to clean up actually arise? Did it arise in year 50? No. It arose the very moment you poured the concrete and contaminated the land.
So I have a debt today for a cleanup that doesn't happen for half a century.
Yes. And Ind AS 116 says you must estimate that cleanup cost now, you discount it to today's value, record it as a provision, which is a liability, and the debit side of that entry. You add it to the ROU asset.
That feels so counterintuitive to me. I am increasing the value of my asset because I have to ultimately destroy it.
Think of it as cost, not value. The cost to use that land includes the rent and the restoration. Both are the unavoidable price of admission, so you capitalize both.
That is incredibly deep. It forces companies to acknowledge their environmental debt on day one.
Exactly. It's about transparency.
Okay, we've added a lot of stuff. Is there anything we subtract? Layer 5 is lease incentives received.
The sweeteners. Sometimes a landlord is desperate for a tenant. They say, sign this lease and I'll give you $10,000 cash to cover your moving costs. Or the first 3 months are rent-free.
If I get a check for $10,000 from the landlord, that reduces my overall cost.
Correct. It's a rebate, so you subtract it from the ROU asset.
So let's recap the grand formula for you. It's the liability plus prepayments plus direct costs plus restoration provisions minus incentives.
If you can remember that exact sequence, you can solve almost any lease accounting problem they throw at you.
Well, let's put that confidence to the test. We promised a heavy-duty numerical breakdown, and we are going to deliver. We're going to walk through illustration 28 from the source material.
This is the infamous 7,035,900 example. Listeners, if you're driving, obviously don't close your eyes, but try to visualize the spreadsheet we are about to build.
Here is the scenario. We have a 10-year lease. The annual payment is $100,000, payable at the end of each year. The discount rate, the interest rate we use to value money over time, is 6%.
Step 1 is to calculate the lease liability. We need to find the present value of those 10 future payments.
I want to pause on discounting for a second because people always nod along to this term, but they often forget what it actually means mechanically.
Sure, it's the concept of the time value of money. If I offered to give you 100,000 rupees today or 100,000 rupees 10 years from now, which would you take?
Today, obviously. I could invest it and earn interest. Or, at the very least, inflation won't have eaten away its purchasing power.
Exactly. Money shrinks in value over time. So when we look at this lease, the 100,000 we pay in year 1 is expensive, it's close to today, but the 100,000 we pay in year 10 is cheap. In today's terms, it's worth much less.
So we have to apply a shrinkage factor to each payment.
That's exactly what the discount rate does. Let's look at the actual numbers from illustration 28. Year 1 payment is 100,000. The present value factor at 6% for year 1 is 0.943. So the present value is 94,300.
Okay, it kept almost its full value.
Now let's jump to year 5. The factor drops to 0.747, so that 100,000 payment in year 5 is only worth 74,700 today.
And year 10, the payment at the very end of the lease.
The telescope has zoomed way out. The factor is down to 0.558. That future 100,000 is only worth 55,800 in today's money. It has lost nearly half its value just due to the passage of time.
So to get the total lease liability, we just sum up all those present values, 94,300 plus, 89,000 plus,
Yeah.
all the way down to 55,800.
And the magic sum of all 10 years is 7,035,900.
Okay, let's anchor that number in our minds, 7,035,900. That is what goes on the credit side of your balance sheet. That is the debt.
But as we discussed, that is not necessarily the asset.
Right. Step 2 is to build the ROU asset using our grand formula. And the illustration gives us some extra data points to make this really spicy.
Let's add the variables based on the principles we just learned. Variable A, the lessee paid 10,000 as a deposit before the commencement date. That's a prepayment. Variable B, the lessee incurred 5,000 in legal fees to draft the lease. That's an initial direct cost. Variable C, the lessee received a 2,000 cash incentive from the landlord. And variable D, the estimated restoration cost at the end of the lease is valued at $1,100 today.
Okay, let's run the math together. Start with the liability we just calculated, 7,035,900.
Add the prepayment plus 10,000. That brings a subtotal to 7,045,900.
Add the direct costs, plus 5,000. Subtotal is now 7,050,900.
Subtract the incentive we received, minus 2,000. Subtotal drops to 7,048,900.
Add the restoration provision, plus 1,100.
And the grand total is 7,050,000.
I really love it when the numbers round out that nicely. So let's compare the two figures. Liability, your debt, is 7,035,900. Asset, you're right, is 7,050,000. They are different. And that difference is composed of the cash we paid up front, the cash we got back, and the future cleanup bill.
I want to visualize the journal entry for you because seeing the debits and credits really locks this concept in. Imagine a giant T account.
Okay, left side, the debit side.
Just one big number, debit right of use asset for 7,050,000.
Right side, the credit side. We need to balance this.
First, we put in the liability we calculated. Credit lease liability for 7,035,900.
We're short. We need more credits.
Well, we spent cash. We paid 10,000 for the deposit and 5,000 for legal, but we got 2,000 back. So the net cash out the door was 13,000. Credit bank or cash for 13,000.
Still need a little more to balance.
The cleanup bill. Credit provision for restoration for 1,100.
Let's check the math. 7,035,900 liability plus 13,000 cash plus 1,100 provision. That equals exactly 7,050,000. Boom, it balances.
It's beautiful, isn't it? It perfectly captures the entire economic reality of the transaction. You have an asset worth 7.5 lakhs. You have a long-term debt. You have a net cash outflow. And you have a future environmental provision, all in one elegant entry.
This is exactly why accountants get paid the big bucks, or, well, at least the medium bucks.
Exactly.
Before we wrap up the technical section, I want to throw a bit of a curveball. We talked about separating components earlier, the burger and the fries, but there is a scenario in Test Your Knowledge Question 4, TYK4, in the source material that deals with something trickier. The fluff.
Ah, yes. The administrative fees and reimbursement.
Here is the setup for you. A customer leases a machine. The contract requires a total fixed payment of $10,000. The contract explicitly says this $10,000 covers three things: rent, maintenance services, and administrative tasks, plus reimbursement for the lessor's insurance.
Okay, so we have a lease, the rent, we have a non-lease component, the maintenance, and we have admin and insurance.
Now, in my head, if I pay $500 for administrative processing, that feels like a service. Someone at a desk is doing paperwork for me. Why isn't that a separate component?
It's a very common point of confusion, but ask yourself, is the admin work transferring a good or service to you, the lessee? When the landlord processes their own internal paperwork, do you get an asset? Do you get a distinct service, like a clean floor or a hired driver?
No. I just get the lease I asked for.
Exactly. The admin work, the insurance the landlord buys to protect their own asset, that is just the landlord's overhead. They're just passing their cost of doing business on to you. It's basically just a hidden price hike on the rent. Therefore, the standard says administrative tasks and reimbursements are not a separate component.
So we just ignore it.
Well, we don't ignore the cost, we still have to physically pay it, but we don't give it a separate line item in our pie chart allocation. We treat it as part of the lease component.
Let's look at the exact numbers in TYK4 to see how this plays out in reality. Total payment is $10,000. We check the market. We find that the maintenance service alone has an observable standalone price of $2,000. We cannot find a standalone price for the lease or the admin. How do we split the $10,000?
Well, we know the maintenance is $2,000. That's a hard, observable fact. Since admin is not a component, it doesn't get its own slice of the pie. It gets absorbed. So we effectively just do a simple subtraction. Total, $10,000 minus the identifiable service, $2,000 equals $8,000.
And that $8,000 becomes the allocated amount for the lease component.
Exactly. Even though we know intellectually that some of that $8,000 is technically admin fees or insurance reimbursement, we capitalize the whole $8,000 into the ROU asset.
The major takeaway here for you is don't get distracted by the laundry list of fees in a contract. If it's not a direct transfer of a tangible good or a distinct service to you, it's just part of the lease price.
Correct. Always focus on the substance of the transaction, not the label the landlord slapped on it.
We have covered a massive amount of ground today. We've gone from the high-level philosophy of rights to the combo meal separation, to the pie chart allocation, to the grand formula, and finally the discounting math.
It's a lot to digest, but I want everyone to step back and think about the big picture. Why does all of this incredibly tedious math actually matter?
The big so what?
So what is comparability? Before Ind AS 116, if you compared an airline that bought its planes, so they had high debt and high assets, to an airline that leased its planes, zero debt, zero assets, they looked like completely different businesses on paper, but economically. They were doing the exact same thing, flying planes they didn't really own outright.
And AS 116 basically levels the playing field. It forces the leasing company to do it. But yes, we have debt. Yes, we have assets.
And that transparency is absolutely vital for investors. It completely prevents companies from hiding their massive leverage in the tiny footnotes at the back of the annual report.
I want to leave you with one final thought. We touched on it briefly with the nuclear plant example, the restoration cost. By forcing companies to capitalize the cost of environmental cleanup today, accounting is doing something very subtle but very powerful.
It is making the hidden cost of pollution and environmental degradation visible immediately.
Right. It's saying that the true cost of doing business isn't just the rent you pay to the landlord every month. It's the damage you do to the earth that you have to fix later. And that cost hits your balance sheet the day you sign the contract.
It's a sobering thought. It makes assets look expensive, sure, but maybe that's just because we're finally being honest about what they actually cost to society.
Does it artificially inflate costs? Or was the old way of just ignoring the cleanup bill until year 50 simply dishonest? On that note of existential accounting dread, thank you for joining us on this deep dive.
Always a pleasure to crunch the numbers with you.
Keep asking questions. If you see a massive number on a balance sheet, ask where it came from. And remember, if it's not on the balance sheet, ask why. We'll see you next time.